Everything else on your calendar can wait. Whatever plans you made for this week, put them aside, because if you hold silver in any form, the next few days may decide whether you walk away relieved or rattled. This is not exaggeration, and it is not designed to provoke fear. What is forming in the silver market right now is something rarely seen, even by those who have followed precious metals for decades. We have just witnessed silver surge to an extraordinary high above $120, only to collapse by nearly 30% in a single trading session. Now, as February begins, price is hovering in the mid-80s to low 90s range, suspended in a zone where markets make decisions that echo far beyond a single week. This is not a normal pullback. It is not a routine correction. It is a pressure chamber. Multiple forces are converging at the same time: economic data, technical thresholds, futures positioning, inventory movements, and psychology. Each one on its own would be meaningful. Together they create a narrow window where direction is decided. What happens between now and the end of this week could shape silver's path for months, possibly for the rest of the year. And most people holding silver have no idea how close this inflection point really is. To understand why the next few days matter so much, you first need to understand what just happened, because the violence of the move itself changed the structure of the market. On Thursday, January 29th, silver reached an all-time high near $121.60. The rally had lasted 9 months. Price had climbed more than 170% year over year. Confidence had turned into euphoria. Momentum traders piled in. Headlines grew louder by the day. It felt unstoppable. Then, within 24 hours, the entire tone shifted. By Friday, January 30th, silver collapsed into the high 70s and low 80s, marking the worst single-day percentage decline since 1980. One of the most violent reversals in modern precious metals history unfolded in a matter of hours. The catalyst was the announcement of a new Federal Reserve nomination, which immediately strengthened the dollar and triggered mass liquidation across metals. Algorithms fired. Stop losses cascaded. Margin calls followed. What looked stable one day unraveled the next. But here's the part that matters most. That crash solved nothing. It did not fix the supply imbalance. It did not reduce industrial demand. It did not refill depleted inventories. It did not change global trade restrictions. All it changed was the paper price. The underlying reality remained exactly where it was before the collapse. That is why the current moment is so dangerous and so important. The market is now trying to reconcile two opposing truths at the same time: a violently shaken paper structure and an unchanged physical foundation. As February opens, silver trades roughly between $85 and $90. That is still far above where it stood a year ago, yet dramatically below where it stood only days ago. Sentiment is fractured. Confidence is shaken. Traders do not know whether the worst is over or just beginning. Long-term holders are questioning themselves. Short-term participants are traumatized. This emotional instability is precisely what makes the coming days decisive. What we are entering now is a convergence. The first component of that convergence is technical. Silver sits directly inside a critical price zone. The region between $85 and $90 is not arbitrary. It represents overlapping support from previous consolidation areas, major moving averages, and psychological round numbers. Markets tend to fight hardest where memory is thick, where buyers and sellers both believe price should hold. If silver stabilizes here, the crash may be remembered as panic liquidation that exhausted itself. If this level fails cleanly, another wave of selling toward the 70s becomes possible. This is not a subtle zone, it is a line in the sand. The second component arrives at the end of the week with the employment report. Labor data plays a powerful role in shaping expectations around interest rates and currency strength. Strong employment numbers tend to reinforce a firm dollar and delay easing expectations. Weak numbers do the opposite. The last crash was intensified by a sudden dollar surge. That means the upcoming data release has the potential to either calm markets or reignite volatility. A single number on Friday morning could move silver 10% or more before most people finish their coffee. The third component involves futures positioning. Attention has shifted toward the March contract, where trading volume and options activity are rapidly building. As traders roll positions forward, imbalances form. Open interest has expanded on both sides, with heavy activity in calls and puts. This does not signal consensus, it signals expectation of violence. When both sides prepare for extreme movement, markets rarely remain quiet. The fourth component arrives later Friday with positioning data that reveals how large institutions and commercial players behaved during the crash. Did they reduce exposure? Did they quietly cover shorts? Or did they press their bets further? This information does not predict direction, but it reveals conviction. It tells you who believes the worst is over and who does not. The fifth component is inventory. Daily vault reports matter enormously right now. Before the collapse, tens of millions of ounces were being withdrawn in short periods. Registered deliverable supply remains historically thin relative to open interest. The question now is whether lower prices brought metal back or pulled even more out. Continued withdrawals would signal that physical demand does not care about paper volatility. Inventory builds would suggest pressure is easing. This data arrives quietly, but its implications are loud. The sixth component is physical premiums. This is the market that does not lie easily. When spot prices fall but premiums remain elevated, it exposes a disconnect between financial pricing and real-world availability. Early indications suggest premiums have not collapsed. Coins and bars continue to command meaningful markups. That behavior matters. It tells you whether buyers are retreating or stepping forward. All six of these forces are converging inside a window measured in days. That is why timing matters now more than usual. Markets do not move smoothly. They compress energy and release it suddenly. The recent crash was a release. What follows determines whether that energy dissipates or reloads. After violent moves, markets typically fall into one of several paths. Sometimes price bounces briefly and then collapses again. Sometimes it recovers rapidly as panic exhausts itself. Sometimes it churns sideways for weeks, grinding confidence down on both sides. The next few sessions begin to reveal which path is unfolding. If silver holds support through the week and responds positively to data, the odds shift toward recovery. If support breaks decisively, fear can return fast. If price whipsaws violently without resolution, frustration sets in and patience becomes the rarest asset of all. None of this means certainty. It means probability. And probability matters most when volatility is high. This moment is not about predicting the future with confidence. It is about understanding the landscape before stepping forward. The worst mistakes are made when people confuse movement with meaning and emotion with information. What just happened rattled the system. What happens next determines who remains positioned when clarity finally arrives. For now, silver is suspended between fear and foundation, between panic and persistence, between those who believe the crash changed everything and those who understand that fundamentals do not evaporate overnight. The market will decide soon which side wins, and when it does, the move will not ask for permission. Once a market absorbs a shock of this magnitude, the next phase is rarely calm. What follows is not resolution but negotiation, a tug-of-war between fear and conviction. Silver is now in that phase. Every candle, every data release, every inventory update becomes a vote on what the future is supposed to look like. This is why the next few days carry disproportionate weight. They are not about confirming what already happened. They are about deciding what story the market tells next. Historically, after extreme one-day collapses, the most dangerous period is not the crash itself, but the silence afterward. That is when participants begin second-guessing everything they believed. Traders who bought the top are desperate for relief. Holders who rode the rally feel betrayed. Those who sold near the lows are trapped between regret and fear of re-entry. This emotional fragmentation creates instability, and instability is fertile ground for large moves. Right now, silver is hovering in a range that reflects that confusion. Price is not rebounding decisively, but it is also not collapsing further. That pause is deceptive. It gives the illusion of calm while tension quietly builds underneath. Markets often behave this way before choosing a direction. They compress volatility only to release it with force when a catalyst finally tips the balance. One of the most important aspects of this moment is that nothing fundamental has changed. Industrial consumption remains at record levels. Energy transition demand continues to grow. Solar manufacturing, electrification, data infrastructure, and defense applications all require silver in quantities that cannot be easily substituted or delayed. Supply remains constrained by declining ore grades, limited new mine development, and geopolitical trade restrictions. None of these forces respond to short-term price action. They operate on multi-year timelines. That is why the paper crash feels so disorienting. Price moved violently, but reality did not. This disconnect is what the market must now resolve. Either price eventually reconnects with fundamentals, or fundamentals are forced to adjust through demand destruction or substitution. The coming days will not resolve that question completely, but they will reveal which direction pressure is leaning. There are several possible paths from here, and each carries a very different psychological burden. In one scenario, silver stabilizes and begins to recover. This does not happen in a straight line. There will be sharp rallies followed by pullbacks that test confidence again, but gradually, buyers regain control. The narrative shifts from collapse to correction. Analysts begin talking about overreaction. Confidence slowly returns. In this environment, those who held through fear are rewarded, while those who sold in panic are left watching price move away from them. In another scenario, support fails. Price slips below key levels, triggering a second wave of fear. Headlines turn darker. Commentators declare the rally dead. Long-term holders question whether they misread the cycle. This is the most emotionally brutal path because it feels like betrayal layered on top of loss. Yet even here, fundamentals do not vanish. They simply wait. Markets can overshoot downside just as violently as they overshoot upside. The third scenario may be the most psychologically exhausting of all: prolonged indecision. Price chops violently between levels without commitment. Every rally fails, every dip recovers, traders get whipsawed. Conviction erodes slowly rather than violently. This phase is designed to exhaust participants rather than shock them. It is how markets transfer ownership from impatient hands to patient ones. Which path unfolds will be influenced by data, but even more by behavior. How traders respond to information matters more than the information itself. A weak jobs report does not guarantee a rally if fear dominates. A strong report does not guarantee collapse if buyers are already positioned defensively. Markets move not on facts alone, but on expectations versus reality. This is why preparation matters more than prediction. Those who enter volatile weeks without a plan almost always react poorly. They chase moves they missed. They sell moves they should withstand. They change strategies midstream. The market punishes that behavior relentlessly. The discipline required right now is not brilliance. It is restraint. For long-term holders, this moment is about perspective. If your thesis was built on multi-year demand growth and structural supply issues, then a single week, no matter how violent, does not invalidate it. Volatility does not equal failure. It is simply the cost of participation. The danger is not price movement. The danger is emotional capitulation. For active participants, this is a period where risk management becomes survival. Smaller position sizes matter. Patience matters. Knowing in advance what invalidates your view matters. Without those boundaries, volatility becomes destructive rather than opportunistic. For those waiting on the sidelines, this is observation season. Watching how price behaves around critical levels teaches more than any indicator. How quickly dips are bought, how strongly rallies are sold, whether volume confirms or contradicts price. These clues reveal the market's internal health far better than headlines ever could. What makes this moment unique is that it follows euphoria directly. The market did not slowly overheat. It exploded upward and snapped back violently. That kind of pattern leaves deep emotional scars. Recovery from that damage is never instant, even when fundamentals remain intact. And yet, markets often do their most important work precisely when participants feel least confident. This is when narratives flip quietly before becoming obvious later. This is when accumulation happens invisibly. This is when long-term positioning begins while short-term attention is consumed by noise. The coming days will not deliver comfort. They will deliver information, sometimes painfully. How silver responds to stress will tell you far more than how high it once traded. Because price memory fades, behavior does not. The market is showing you what it values, what it fears, and how it processes shock. Paying attention now, without rushing to act, is itself a strategic advantage. The convergence is still unfolding. The decision has not been made yet, but the pressure is rising. And when pressure finally breaks, it rarely does so quietly. As the week unfolds, one thing becomes increasingly clear. This is no longer just a price event, it's a credibility event. Markets are not merely asking what silver is worth. They are asking whether the signals they rely on can still be trusted. After a move, this violent confidence fractures. Traders stop trusting charts. Investors stop trusting narratives. Even fundamentals feel abstract when price behaves irrationally. That's when markets enter their most dangerous and most revealing phase. Because when confidence breaks, behavior changes, you start seeing hesitation where there used to be momentum. Volume dries up at moments when it should surge. Rallies feel tentative. Sell-offs feel panicked. This uneven behavior is a tell. It means participants are no longer acting from conviction, but from fear of being wrong. And fear is not directional. Fear amplifies whatever move happens to start first. That's why the next impulse matters so much. Not because it determines the final outcome, but because it establishes psychological dominance. Whichever side wins the next major push, bulls or bears, gains narrative control, and narrative control moves money. If price begins rising and holds, confidence returns faster than expected. Market participants reinterpret the crash as a necessary purge. Headlines soften. Language shifts from collapse to reset. Suddenly, what felt terrifying days earlier is reframed as opportunity. But if price weakens again, something darker happens. Participants stop viewing the drop as temporary. Doubt becomes embedded. Long-term holders begin questioning timing. New buyers hesitate. Liquidity thins. That environment allows even small sell orders to move price disproportionately. This is how markets drift, not because fundamentals vanish, but because trust erodes. One of the most overlooked elements right now is time, not price, time. The longer silver holds above its recent lows without breaking down, the more selling pressure exhausts itself. Panic is powerful, but it burns hot and fast. It cannot sustain indefinitely. Every hour price holds becomes a quiet victory for stability. This is why sideways movement after crashes is not weakness, it's digestion. Markets need time to reallocate ownership. Weak hands exit, stronger hands step in gradually. This transfer rarely happens during dramatic candles. It happens during boredom, when attention fades. That's when positioning quietly shifts. Meanwhile, physical market behavior continues to tell its own story. Premiums, delivery delays, dealer inventory levels, these do not react with the same speed as futures markets. They move slowly, stubbornly, often ignoring paper volatility entirely. When that divergence persists, it creates pressure. Not explosive pressure, structural pressure. The kind that doesn't resolve in hours, but eventually demands reconciliation. Either physical demand weakens enough to align with lower prices, or price must rise to ration limited supply. There is no third option long term. Short term, however, the paper market can create illusions. It can compress price below equilibrium. It can exaggerate fear. It can trigger forced selling. But it cannot create metal. It cannot manufacture supply. That's the constraint quietly tightening beneath the surface. What makes this moment especially complex is that both sides have valid arguments. Bears can point to technical damage, broken momentum, and shaken sentiment. Bulls can point to persistent deficits, industrial necessity, and physical tightness. This is not a simple trade. It's a standoff, and standoffs resolve violently, just not always in the direction people expect. One mistake many participants make in moments like this is assuming that volatility means chaos. It doesn't. Volatility means transition. The market is moving from one regime to another, from acceleration to evaluation, from trend to judgment. Those transitions are uncomfortable because the old rules stop working before the new ones become clear. Indicators that looked reliable during the rally suddenly fail. Correlations break. Confidence in strategies collapses. This is normal, but few are emotionally prepared for it. The winners in these phases are rarely the most aggressive. They are the most adaptable. Adaptability does not mean constant action. Often it means restraint. It means waiting for confirmation rather than anticipation. It means accepting uncertainty rather than fighting it. This is especially true now, when the market is hypersensitive to headlines, data releases, and positioning shifts. Reactions may be exaggerated, reversals may be sudden. That environment punishes impulsiveness brutally. What matters most is understanding your role. If you are an investor, your advantage is time. If you are a trader, your advantage is discipline. If you are a newcomer, your advantage is patience. Confusing those roles is what causes damage. An investor who trades emotionally becomes unstable. A trader who invests without risk limits becomes trapped. A newcomer who chases certainty gets punished. Right now, the market is testing identity as much as strategy. The coming sessions will not be about being right. They will be about surviving uncertainty intact. Capital preservation, financial and psychological, becomes the priority. Because when clarity finally returns, opportunity follows. It always does. But opportunity only matters if you are still positioned, mentally and financially, to act on it. This is the quiet truth few talk about. The market does not defeat most participants through price alone. It defeats them through exhaustion, through doubt, through forcing decisions at the worst possible moments. That is the real battle underway right now. Not silver versus the dollar, not bulls versus bears, but patience versus panic. And the next few days will reveal which side most people are truly on. When markets survive a shock of this magnitude, they don't rebound the way most people expect. There is no clean reversal, no dramatic announcement, no clear bell ringing to signal that danger has passed. Instead, something far more subtle happens. The character of price action begins to change. The first sign is not strength, it is restraint. After violent sell-offs, markets often stop falling not because buyers rush in, but because sellers run out. The urgency disappears, the fear burns itself out, volume declines, candles shrink. What once felt chaotic becomes strangely quiet. This quiet confuses people. Many interpret it as weakness. They expect continuation. They wait for another collapse that never arrives. Meanwhile, positioning quietly rotates beneath the surface. This is how bottoms are formed, not with drama, but with indifference. At turning points, participation is low, attention is minimal, optimism is absent. That is precisely why they work. By the time confidence returns, price has already moved. If silver is in the process of forming a base, it will not announce itself. It will feel uncomfortable, unresolved, and unsatisfying. It will refuse to give clarity. That ambiguity is not a bug, it is the mechanism. Markets rarely reward certainty, they reward endurance. Another important shift to watch is correlation behavior. During panic phases, everything moves together. Dollar up, metals down, yields spike, risk assets fall, correlations tighten, but as stress fades, correlations loosen. Silver may stop reacting violently to dollar strength. It may hold firm on bad news and rise on neutral news. These subtle asymmetries are early signals of regime change, far more reliable than headlines. This is also when narrative fatigue sets in. After enough repetition, fear loses its power. The same bearish arguments stop producing the same reactions. Price begins to ignore what once mattered. That's often the earliest warning that a trend is preparing to turn, not because conditions improved, but because everyone who could sell already has. This process is rarely fast. In fact, impatience is what prevents most people from benefiting from it. They want resolution immediately. Markets operate on different timelines. They compress pain into moments and stretch opportunity across silence. That mismatch creates frustration. You will hear phrases like nothing is happening or this market is dead. Those are not observations, they are emotional tells. They usually appear right before movement resumes. The market's goal at this stage is simple: discourage participation. If too many people remain interested, price will not move. If too many are waiting for confirmation, confirmation will be delayed. Once attention fades, the path clears. This is why the most important thing you can do now is not predict direction. It is preserve optionality. Stay flexible. Stay liquid. Stay mentally available. Optionality is power. When volatility returns, and it will, those with optionality act. Those without it react. Another crucial element is narrative transition. Every major move requires a new story. The old story, rally, euphoria, collapse, has already played out. The next one hasn't been written yet. It may involve inflation data, it may involve industrial demand headlines, it may involve geopolitical tension, it may involve supply disruptions. It almost doesn't matter what the catalyst is. Catalysts do not create moves. They justify moves that are already positioned to happen. The market only needs an excuse. And when it finds one, price adjusts far faster than logic allows. That's why waiting for certainty is dangerous. Certainty arrives after repricing, never before it. What you're experiencing right now, in the uncertainty, the conflicting signals, the emotional strain, is not accidental. It is the cost of transition. Those who endure it without self-sabotage are usually the ones still standing when momentum returns. The worst decisions are rarely made during crashes themselves. They are made afterward, during the quiet, when doubt whispers that maybe the story was wrong all along. That whisper has ended more long-term positions than any sell-off ever could. So understand this moment for what it is, not an ending. Not a confirmation, but an intermission. The market is catching its breath, and when it inhales again, it will not wait for consensus.